Mahesh Patil joins us, Co-Chief Investment Officer with Birla Sun Life. Mahesh, good morning. Thank you for joining us. Mahesh, what do you make of RBI action? Too late, too little? Are they confusing markets more? Because 15 days ago they indicated something else. Within 15 days they've completely taken a 180-degree turn.
Yeah, I think this action was to some extent forthcoming, because I think what we have seen RBI intention was to actually harden the short-term rates, and unintentionally we have seen even the long-term rates, the bond yield, G-Sec 10-year yields also spiking up as a result. And I think as they realized that, I think it would have a larger repercussions, especially on some of the banking stocks, where they would have a huge mark-to-market losses of the tune of around 30,000 crores, which they can ill afford at this point in time, where there's also asset quality concern and hit on the P&L because of that. So I think the measure, as RBI mentioned yesterday, is to ensure that interest rates remain high, but at a level which is desirable at around around 10.5%, 11% or so, and really lower the long-term rates, so that because government also will be in the market to borrow sometime later, and the rates which had spiked up to around 9.5% was something which was unsustainable. So I think measure, I think what they have taken is something which was expected. Only the timing was an issue really. And I think what it does is that really on the rupee front, okay, what are the other measures, okay, what RBI has really to contain the rupee depreciation, because okay, that still remains open at this point in time.
Mahesh, so what's the approach really? I mean, should one just play for a trading bounce in the bank nifty because the sector was so oversold, or is it now time to start nibbling into the sector and buy for a medium to long term?
Well, our view has been that in the banking space, there are two ways. I mean, one to look at it is that on the asset quality, there is going to be concern, especially with the kind of slowdown what we are seeing. And so we'll see corporates coming under stress, the NPA is increasing. So banks which are slightly vulnerable to that, I think we'll still stay away from that, despite a bounce because of these measures. Because on the investment book, yeah, there will be the initial losses which were predicted, I think that would come down. But clearly, I think focus. I think some of the private sector banks we have seen a decent correction. So I think where the valuations are looking reasonable, it could be a good time to really add from a medium to long term perspective, because our belief is that these measures, heightened interest rates, won't be continued till in the longer term. I think again it would last for 3 to 6 months or so. There will be impact on banks on the NIMs to the extent of around 20 to 30 basis point. But I think the correction which you have seen in some of these banks, especially the better quality names, has been much more. So I think at a price from a medium-term perspective, I think in a long-term perspective, it's a good time to look at some of these quality banks.
Mahesh, what is your sense? Do you think the dichotomy that we were seeing in the market up until now, where banks were under pressure, IT, select pharma, select FMCG, were outperforming, now that trade is going to reverse for a while?
Well, we have seen that time and again. We have seen sector rotation happening pretty fast in the recent times. And that's the danger actually, when sectors where there is a concern, or where there is some concern in terms of growth or outlook, we have seen those sectors getting punished or hammered at valuations reaching levels which are way below their long-term averages. And sectors where the outlook has been good or reasonably okay, we have seen the valuation on the higher side. So any turn in sentiment, I mean, there's always a risk that the trade could reverse. And that's the risk, I think, which we've been cognizant, and as a result, we never had any skewed bets in any particular sector at this point in time, because the divergence across some of the sectors compared to the historical averages has been at the highest level what we have seen recently.
So, Mahesh, at the current juncture, what is a prudent course of action? Should one still hide into defensives, stay, overweight on IT, or now it is time to give these crowded trades a skip, and now it is time to start treasure hunting in banks and beaten down industrials and some metal stocks?
No, I don't think it is time to really start bottom fishing. I think clearly, one should still maintain discipline. I think just because some of the FMCG stocks or some of these pharma stocks which are doing reasonably well, but the valuations are very high, doesn't make sense to really hide over there, because I think in the market correction what we see now, especially when we see that FIs are pulling out, I think in that correction everything is likely to fall if the markets correct from here, because further fall in the market from these levels has to be led by some of these stocks which have been holding on. So it wouldn't be prudent to really just hide for the sake of hiding, but certain stocks in the correction, even the better quality in the IT space, if they have corrected and they come to a reasonable level, and where the outlook still remains very decent, I think it could be a good time to hold on, even add in this correction. At the same time, not getting carried away in this rally in some of the banks, because as I said, the concerns in terms of growth, in terms of margin pressure and asset quality still remain. So one has to be really selective in terms of stocks which is picking to. I think it's more of coming down to stock selection rather than taking any sectoral bets at this point, because as I said, the divergence is still pretty high.
What do you think, Mahesh, seems to be working in favor of the metals pack? Because that, even when the market was weak, was a space which was bouncing up.
Yeah, I think actually metal, the trend has been pretty surprising, because we have seen globally metal stocks doing reasonably well in the last 3 months. And we've seen prices moving up of metals across in the last 3 months, whether it is aluminium, copper, zinc, for that matter. And our stocks were underperforming. But I think recently we have seen some kind of spike up in the metal names, primarily because of two factors. One is that rupee depreciation. In fact, I was just looking at some of the charts. I think the prices, metal prices like zinc, for example, or lead, they are back to the 2008 highs in rupee terms. Okay, and where the stocks are down almost like 50% from those levels. So clearly, I think there was great value over there, and we've seen some positive signs coming in from Europe. Okay, Europe is doing well, so we've seen steel prices moving up. And more recently, I think data from China was looking a bit positive. So I think all these factors and the current fact that the valuations were extremely beaten down, we are seeing some rally in these stocks right at this point in time.
Mahesh, what is your take on earnings now? Brokerages have clearly marked down their GDP estimates and earning estimates for FY14. Do you think the fear factor in the system is slightly overdone and earnings could surprise us?
No, I think there is some risk to earnings, because if you look at the beginning or starting of the fiscal year, the GDP numbers were slightly on the somewhere around anywhere close to around 6% or so. Now I think it's coming down to around 5%. So clearly that will have an impact in terms of growth. Again, interest costs, one was expecting them to at least remain flat or come down, but doesn't look like that will happen. So again, there could be a slight increase. So to that extent, I think one could see some downgrade to earnings. But I think if you look at the Nifty stocks, almost 50% of the weightage, the companies will actually benefit because of rupee depreciation, because of the exposure either in the IT space, the metal space, or oil and gas sector, or the pharma sector for that matter. So I think on balance, I think you will see some downgrade, but it won't be such a large downgrade. That's what we believe. But yeah, definitely there would be some downgrades to factor in the slower growth and the fact that interest costs have moved up.
Mahesh, what have you made of this whole NSCL fiasco, and does it seem like it sends out a very wrong signal to the FII community at a time, in any case, when the macroeconomic picture is in such a limbo?
I think NSCL, I think, has been operating. I mean, it's not like a regulated exchange. So in that scenario, I don't think anyways FIIs and the investors were never a part of that. So yeah, where it has its own repercussions in the domestic side, because a lot of investors who would have invested, and so that could lead to some pressure. We've seen some impact of that, because whenever we see a domestic crisis, there is some pressure, because a lot of margin money which has been paid, or stocks which have been pledged, they have to be sold off to pay up for those defaults. But I think FIIs would really be too spooked by that, because it was never regulated, never came under a particular regulation. And I think the exposure in that, I don't think any of the FIIs really dealt in that. So I don't think that's really going to really be on their mind.
Mahesh, do you think equity markets are capturing in the impact of bond yields, which have gone up to 8.5%, and rupee, which is at 64, or currently rupee markets are not really capturing the impact of macro?
See, I think rupee at these levels, if you look at it, I think it's now probably looking slightly undervalued actually. So I think the correction has been done, but I think the challenge with the rupee, the movement is not so much the fundamental, but more in terms of the technicals, in the liquidity, because we are not seeing much support coming in, because while our current account deficit is coming down and is likely to come down. But on the balance of payment, I think there is still a challenge, because to match those flows in the kind of environment, global environment, we have seen concerns of tapering rising and outflow from emerging markets. I think that's what is putting a pressure on rupee, and that needs to be corrected and how that could be balanced out. So I think even in terms of the bond yields, moving up, clearly I think that puts a pressure on the corporate side, because at an environment where you're still seeing corporate balance sheets, if you look at a lot of large companies in the infra space, their debt equity ratios are very high at these levels. And any increase in interest costs at this point in time would put a further pressure over there and lead to, as I said earlier, concerns in terms of defaults rising in the system. So that's, I think, a big concern, and that still remains, though we have seen some moderation in terms of bond yields, but I think the interest rates will still remain high for some time.
Mahesh, in one word, if you have to summarize your current market outlook, are you worried, are you bearish, or are you slightly disheartened the way how fundamentals are shaping up?
Well, I think clearly we are cautious at this point in time, because there's too much uncertainty around. I think what we've seen in the currency market, what we've seen in the debt market, interest rates moving up, globally how things are turning, I think we are also at the cusp of that. So I think things are going to remain volatile and uncertain. So I think we are cautious, though I think the correction what we've seen in the market recently provides a decent opportunity to really start looking at stocks at valuations which ones are looking comfortable. That doesn't mean that you might not see further downside because of what's happening. So I think while not being too pessimistic at this point in time, I would still remain cautious and be careful trading in this market. But opportunities come in these times of uncertainty, of panic, and these are opportunities which, if you're able to really keep our eyes wide open, you can identify good stocks which can give good returns for the next 2 to 3 years perspective. I think next 6 months is going to be a period where you will see a lot of volatility and concern, but I think this is a time where long-term investors looking to enter into the equity market could be a good time. And as long as interest rates remain high, elevated levels, I don't think the equity markets will do too much, but we will know for sure that with growth slowing down, rates have to come down eventually. And that's the time when you would see even the outlook start to improve for the equity market. So I think longer term we still remain positive, but near term remain cautious on equity markets.
Fair point, Mahesh. Appreciate your time and thank you for your valuable insights.